Today, we are diving into a fascinating market mystery. It's a moment when a huge global crisis sent shockwaves through the financial world, but, and this is the key, not in the way anyone expected.
You know, there's this classic playbook, right? It's practically a rule written in stone. When the world gets scary, investors run to so-called safe assets. But what happens when that rule seems to just break?
All right, to get to the bottom of this, we first have to set the scene. And we're not talking about some minor headline here. This was a geopolitical earthquake that put the entire world on edge.
I mean, over just one weekend, things escalated fast. US and Israeli strikes hit Iran, and in a shocking development, Iran's supreme leader was killed. State media reported over 200 casualties. Iran's response was swift, retaliating against US bases, which tragically resulted in the deaths of 4 American service members. This is exactly the kind of event that normally sends markets scrambling for cover.
So, let's do a quick refresher on a really key concept here, a safe haven asset. Think of it as your financial storm shelter. We're talking about things like gold or US Treasury bonds. When chaos erupts, the idea is that investors pour money into them, expecting their value to hold up or even climb.
But here's where it gets weird. This time, the market just didn't follow the script. One of the world's most trusted safe havens started to behave in a very peculiar way. It created a real puzzle for everyone watching.
Okay, so here's what should have happened. A major conflict breaks out, investors get scared, they rush into both gold and US Treasury bonds, and boom, prices go up. And yeah, gold did exactly that. It acted just as expected. But US bonds? Whoa, their prices were actually falling, the complete opposite of a safe haven move.
This was the question blinking on every trader's screen. I mean, why was the world's #1 financial storm shelter, US government debt, suddenly springing a leak?
And it turns out, the market wasn't ignoring the fear of the conflict. Oh no, it was just terrified of something else even more. A completely different kind of fear was taking over the driver's seat.
All right, so where do we start our investigation? Well, our first major clue comes from the one commodity that powers pretty much the entire global economy, crude oil. The conflict was right in a critical region for energy, and you better believe the market reacted instantly.
And boom, WTI crude oil prices shot up by about 7%. Now that's not just a number on a screen. It was a massive red flag that the cost of energy for everything and everyone was about to get a whole lot more expensive.
And that spike in oil prices, it was like throwing gasoline on a fire the market was already deeply worried about, inflation. See, if it costs more to ship goods and power factories, prices for everything else start to creep up. And for the bond market, inflation is basically the ultimate villain.
And you could see the fallout right here. Yields on government bonds surged, with the key 10-year Treasury climbing back over 4%. And we have to remember the golden rule of bonds. When yields go up, their prices go down. This is the opposite of a flight to safety. This is a flight away from it.
So now we have the heart of the mystery, right? You've got these two classic safe havens, gold and bonds, moving in completely opposite directions. The key to solving this whole thing is figuring out why one was so spooked by inflation while the other wasn't.
And this quote from Alliance's Mohamed El-Erian, it just nails it. The bond market was essentially screaming from the rooftops that its fear of rising inflation was way bigger than its fear of a global conflict. That classic flight to quality instinct, it was being totally overpowered.
So, let's break it down. A bond is basically a promise to pay you a fixed amount of cash in the future. But if inflation is running hot, that future money is going to buy you a lot less stuff, right? The value is literally eroding. That makes the bond less attractive. Gold, on the other hand, is a physical asset. It's often seen as a real store of value that holds up when the purchasing power of your money is falling.
You know, this whole event gives us a really powerful lesson about how markets actually work. It's never just about one single thing happening. It's about how that one thing smashes into the economic environment that already exists.
So, let's just trace the logic, the chain reaction. Step 1, a major conflict breaks out. Step 2, that conflict threatens oil supply, which spikes prices. Step 3, the oil spike ignites fears of widespread inflation. And Step 4, for the bond market, that fear of inflation became a much more immediate threat than the conflict itself, causing investors to sell, not buy.
And really, that's the ultimate takeaway. Nothing in the market happens in a vacuum. The broader economic context, in this case, a world already on high alert about rising prices, acts like a lens. And every new piece of news, even a massive geopolitical crisis, gets viewed through that lens.
and that can change everything.
It leaves all of us with a really critical question, doesn't it? In a world where the old playbooks are being rewritten by new economic fears, it forces us all to ask, when the old rules start to bend, where do you actually find safety?